Hi, this is Dustin with Dustin's Dollars. Today I'm going to be giving an update on AITX. My title is still a zombie company, and I will explain what that means. This was a video that was requested by Kirk in a comment. Right here it is. Time for another AITX assessment, please. They just released Q1 results. Sorry, Kirk, I am 2 months late on this, but I'm finally getting to it. Um, and before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine. They do not represent those of any company or any other individual. Um, I do not hold any position in AITX at all, long or short. Uh, but this video should be for entertainment purposes only. Because I could be wrong about everything I say in this video, you need to do your own research before making any investment decisions. All right, so I was requested to go over AITX. I don't follow the company that closely. I'm not invested in it. I did a lot of research, I don't know, a year and a half ago, decided not to invest in it, and have not followed too closely since then. But I was as requested. I want to remind this because I mentioned this in every AITX video that I have. Before I go into, sort of the most recent numbers that they filed in the most recent quarterly report, I want to maybe go over what I would consider to be red flags, reasons why I am not invested in the stock. So real quick, I think the gross profit numbers, they just don't make sense to me, right? I have a whole video talking about this. It was, I think, like a 30-minute video a year or so ago going through their numbers. The gross profit, looks like it's up near 80, 70, 80%. But then when I compare that to the costs of the inventory that I see them spending, like something doesn't up to me. I don't understand how they're actually reporting their numbers and which numbers are going where. So it's really hard for me to evaluate the company. That in and of itself just is a very, very, prevents me from investing in the company. Another really, really big one for me is that there are these anti-dilutive preferred series. I think they're the Series F shares. Sorry, I wrote that down. I believe they're the Series F shares. They're actually the majority of the company's equity. And the CEO, as far as I know, does not hold any common stock. The CEO only holds these anti-dilutive preferred Series F shares. And just to sort of underscore that, I did open this up, I think, in another tab where you can see this was their most recent filing. Or a very recent filing. This is the Form 14C, I think, where they actually, I think, we're announcing the approval of the increased share count, which I'll get to in a little bit. But just to drive this home, talk about Steven Reinhardt, who is the CEO, I believe. This says the effective ownership that he has over the company is equal to roughly 23.5 billion common shares, and this is because of, you could see here, you see the footnote number, footnote number 2, footnote number 3. Mr. Reinhardt holds 2450 shares of Series F convertible preferred stock, and so this should drive home to you that there were, again, this was based on about 7 billion shares of common stock outstanding, and so this is the total amount of common stock that is issued, but then these Series F shares are actually equivalent to significantly more, right? 23.5 billion from his stake versus 7 billion for all current common shares outstanding. And so that is a bit of a red flag to me. Another thing that I really is weird, I haven't seen anywhere else, and I don't like about the company, about 16.25% of their top line revenue was sold. You can read it in their reports. I think they report it as a deferred variable payment obligation, I believe. I think in some places they also refer to it as a sale of future revenue or something like that. You can read all about it, but if I understand correctly, it basically means almost 60% of what they make in revenue, is taken directly off the top line and has already been spoken for by somebody. Somebody is not the equity holders. And one other thing here is the R&D for the company is nearly entirely outsourced, but it's outsourced to a related party. And so, like, that just is kind of weird, doesn't make a lot of sense to me. I don't think it's been explained to my full satisfaction. Maybe that explanation is out there somewhere, but for me, that it just seems off. And so those are all the things to me that really stuck out, even over and above the numbers, which I will go through now. All right, so I can close a couple of these tabs. Those basically were what I wanted to go through. And now I will try to go through, I have some charts that I put together to sort of talk about the current state of the company. So one of the big things, AITX, folks like to talk about the revenue growth. And they say, AITX is still, I think, described as a startup. And, for startups, you really want to see revenue growing. The classic saying is up and to the right. That's what you want your graphs to look like here. And this is, if I got the numbers correctly, taken off of their quarterly revenue numbers for the past, I don't know, 4 years or so. And you can see here, you know, relative to last quarter, did tick up. Relative to the quarter before, I think it was still slightly down. And if you just look over here, you can see they've had a number of quarters where their revenue did tick, was in the same vicinity as where they are now. You can see it looks like it was roughly flat since about the beginning of 2022 or so. You can see the rental activities, because I actually split it out. This is these areas here on the chart are stacked. So the red line is actually showing you the uh, total revenue of the company, and then the red area here is showing you their direct sales, and then the blue line and the blue area are showing you their rentals. And you can see that the rentals did dip down and now have come back up, and so that is, it's hard to say as at this point if that is a trend or not. But just looking at their overall top line revenue, you can see that things have been, just eyeballing it, roughly flat for a good year and a half or so. Again, this is looking at the past, maybe the future, maybe the will go up and to the right, but these are the numbers that I'm reporting on today, and how the company has gone. So the revenue growth is ticking upwards, but not, over a slightly longer trend, I would not say is an uptrend even now. The gross margin is another thing people point to, and as they reported, you can see the gross margins were up this quarter, back in this range, above 75%, where they look very, very healthy. And again, I do not quite know how to interpret these numbers in the context of some other things in the reports, as I mentioned a couple of minutes ago, but just at face value, the gross margins actually were pretty good. Now, let's get some of the negatives. The dilution continues to go up and up and up, right? Because you see revenue. Let's just be charitable and say that it is in an uptrend. Let's look at gross margins, say they're very healthy. That's what you would want for a startup. So why would it, why would I not be invested, or just giving you some insight into the company, what might be on the other side of this. The dilution is a big factor here, because despite that revenue and those gross margins, they are not a profitable company at the time, and they have to fund the company some other way. And so you can see this is their shares outstanding over time, and as of about 3 years ago, they were at, 500 million shares outstanding or so, if I can eyeball it correctly. And now they are up to about 7 billion shares outstanding, and that has just continued to go up. And you can see that actually, if I plot the revenue per share, that has gone down over time. So this is another thing, even though the revenue might be going up, the dilution has also gone up to the point where even the revenue that you have a claim on per individual share of the company has been trending downwards. The other thing is they've been taking on debt. And so over the past, 3 years or so, the debt has gone up, and it has pretty much not gone down. And you can see that's still just going up in these most recent quarters, slightly slower. This is a huge jump up here, but it has gone up slower, but still is continuing up in the recent quarters. But actually, in relation to the revenues into the company, this is a massive amount of debt, right? I think this is $27 million or so. And I got to this point by adding up, 3 different lines. I can even show you precisely in their quarterly report, just so you can check my numbers if you want. I got these numbers by adding up their loan payables of the related party, their current liabilities, and the current portion of their loans payable. So this number right here, and then also adding in their long-term loans payable, which would be this number right here. You add those all up, you can just eyeball it here. This is about 10 million. This is about 16 million, and then this one is actually pretty inconsequential, but you add these together, and so you're about 26 million, maybe 26.5 million dollars in at the end of May, not currently, but at the end of May, in just loans payable. And so that's effectively what I'm measuring here when what I'm calling debt. Getting back to my slideshow, and that really gets us to one of the really big things to take a look at, which is that the revenue does not even cover their interest payments. And so these are quarterly numbers. So this shows you what that trend has looked like over time. And the red line is the interest expense each quarter, and the blue line is the revenue that they brought in each quarter. And you can see that red line is significantly above that blue line. And so even still in the most recent quarter, they owed more on the interest on their debt than they even brought in revenue. So this is where a zombie company is usually one where we say the company can stay alive, but it can't actually pay back its debt. That is true for AITX, but they were even worse to the point where they cannot even pay back their interest with their current revenue. So they'd have to grow revenue just to get to the point where they can cover their interest expenses, not even paying back debt, just paying the interest on the debt that they already have. So how is the company actually funded? So let's use some actual numbers here. Their net cash used in operating activities was just a tad under $3 million. Just for the sake of completeness, I also added in this repayment of loans payable of $27,000. That was also cash out the door. But so in order to spend this, let's just round it off to $3 million. Where do they actually get that money? Because this is actually after revenue, right? The revenue and then subtracting all the expenses. This is saying in their operations they didn't make money. They actually used $3 million. So how are they making up that shortfall from their operations? Well, in the most recent quarter, they drew down cash by about $650 million. You can see they started the quarter. I think this is right here on their balance sheet. Yeah. So they started the quarter in February, at the end of February, with just under $1 million in cash, $939,000, and they ended about $287,000. So they did actually draw down their cash a bit. They also issued shares, right? They diluted and they brought in about $1.3 million by issuing equities. And they also brought in about $1 million, just a tad over, from issuing new debt. And so you look at these numbers and see this is how they're funding the company. They issued shares for $1.3 million. They issued debt for $1 million. And then they also drew down their cash by $650,000. And that's how they actually are funding the majority of the expenses for this company. Not through revenue, not through their actual operations. Now, they did make, they're trying to make some improvements. They did some reductions in personnel, and they expect this to reduce their monthly expense burn by $200,000-$300,000. And so that's a lot of money. Let's take a look at, and maybe try to answer the question, is that enough? And what impact is that going to have? So let's take the midpoint, right? They said $200,000-$300,000. Take the midpoint, call it $250,000. That amount of monthly savings, because they called it monthly, right? Monthly expense reduction. That would be $750,000 per quarter, which starts to get pretty significant. Now let's also throw in a hypothetical because they put out some press releases. Looks like sales are going well, and let's hypothetically say that they tripled their revenues overnight from this prior quarter, right? So in this quarter, we can look and we can see their revenue for the quarter was $385,000. Let's say they triple that, and so they're bringing in terms of new revenue, it would be, let me do the math real quick, $385,000 times 2, so that would be $770,000 of new revenue if they tripled. And so just doing the math on that, let's say they also had 80% gross margins. Now, from that, we have to remove the 16.25% that is already promised to the folks who purchase this through their deferred variable payment obligation. And so that gets them down from an 80% to about a 63.75% effective gross margin. And so the additional cash, from that actual revenue at that level of effective gross margin would bring in about $491,000 per quarter. So with that, and then you combine with that cash that they would be making from new sales, you can also combine that with the savings of $750,000 per quarter from the personnel cuts. And so now we are getting at a number which would be about $1.24 million per quarter in savings from those two actions. Now, if I use the most recent quarter, they would still be losing $1.75 million per quarter, right? So this is after the personnel cuts. This is if they hypothetically tripled their revenue overnight. On a quarterly basis, they would still be losing $1.75 million per quarter. So it looks to me like the company is still in a pretty bad spot. And still to me seems like they're headed out to bankruptcy. I think my first time I really looked in the company and I made my initial impressions into a video, and I said it looks like they're heading towards bankruptcy. They have been able to issue more debt. They've been able to defer, push out the principal repayments on some of their debt, and so I think that has actually allowed them to stay alive so far. As I said, I think they're still in the zombie state where they're not close to a path right now where we can see from actual numbers of of getting to a point where they would ever be able to pay back this debt, and even now not even be able to pay the interest on the debt that they have. But they did put this in their most recent report where they said about 87% of their loans payable are controlled by one individual, and that debt has been extended by this debt holder twice in the past. And they said this debt holder has been a strong supporter of the company. So if the debt continues to get deferred, they wouldn't have to pay back this debt, and especially if this entity continues to actually issue new debt, giving them cash. Of course, the company could stay alive if someone is just giving them more and more loans. And the other thing that I would say is dilution is likely to continue. They did have this equity financing agreement, they called it. They had some agreement, and just FYI, I did look into it a tiny bit. They're selling the shares to this entity at about 80% of the market price. There's some other caveats in there that might push that percentage up a little bit, but just to be aware, if you are following the company, that they are not issuing this at the actual market price. They're as far as AITX is concerned, they are selling these shares to this entity at 80% of the market price, so that entity is getting a discount. And I have the that's where it's at. That's my source link. And then they did increase the authorized shares from 7.225 billion to 10 billion. I believe that was just approved. And I just did the math real quick, and this is as of now, not at the end of May, but at the current price of $0.0039 per share, there's 2.84 billion shares outstanding as of today, as far as I know. And you just do the math, that gets you to roughly $11 million remaining, if they issue all those shares at the current price. So that can give you at least some insight into how much runway they have left, at least with this amount of shares. And if that price continues to go down because they're selling these shares, and that just causes selling pressure on the stock and pushes it down, that $11 million as an estimate of their remaining runway would even go down further. So that was really all I had to say today. I think hopefully that gives you some insight into the current state of the company financially, or at least the state as of the end of May, and a little bit, of more recent data. I don't think the company's in a very good spot. I would not personally invest in it. Not financial advice. You do whatever you want. Hopefully what I went over today at least give you some insight into the company, helps you understand them better. So, all right, that is all that I had today. I don't see anyone on the chat today, which is fine. I didn't do this on a normal time. I do not plan on doing a whole lot more videos on AITX. I am not following the company closely, but folks continue to request it. I will try to accommodate that.